Good evening, everyone. As usual, I'll try and walk you quickly through some of the key highlights of the quarter's results, and we'll take questions thereafter. So for the quarter ended December 31st, 2017, the bank's total income was 24,450 crores, which was up from 20,748 crores. Net revenues, which is net interest income plus other income, these increased by 23.9% to 14,183.5 crores. The net revenues came 73% from net interest income and 27% from other income. The net interest income growth was 24.1% on the back of a core NIM of 4.3 and asset growth. Other income was 3,869 crores. This grew by 23.1%. By 23.1% over the corresponding quarter of last year. Of the four components of the other income, commissions accounted for 2,206.8 crores. So that's the largest component from the 3,869 crores. Commission growth was 30.1% year on year. The FX revenues were 426 crores. The bond gains were 259 crores. And recoveries and miscellaneous income was 311 crores, which all totaled up to the 3,869 crores of other income. Operating expenses for the quarter were at 5,732 crores, which was again an increase of 18.4% over the corresponding quarter of the previous year. And that meant that the core cost to income ratio was at 41.2%. Total provisions were at 1,351 crores. This is as against 715.8 crores for the December 16 quarter and as against 1,476 crores for the September quarter. Moving on, post-tax net profit was 4,642 crores, and that registered a growth of 20.1%. Balance sheet size touched 9,49,000 crores. Our total deposits at 6,99,000 crores grew by 10.1% over December of 2016. Current account deposits were at 1,01,000 crores and savings account deposits were at 2,05,000 crores. And the CASA ratio, therefore, as at December 31st, 2017, was at 43.9%. Total advances were at 6,31,000 crores and grew 27.5% year on year from December 31st, 2016. Both the deposit growth and the loan growth, there's a bit of a distortion in the rates of growth because of the base effect. December 2016, as all of you would recall, was the demonetization quarter. So the base for deposits was much higher given the sudden spike in deposits we had seen during that quarter. And on a relative basis, the loan growth was a little muted because we had some repayments in business banking and so on. So as a result, the base was lower for loans and higher for deposits, which is why the loan growth at 27% year on year or 27.5% year on year is clearly higher than what it has been in the last couple of quarters. And on the other hand, the deposit growth seems that much lower at around 10.1%. If you look at the sequential growth in both of these, you'll find that deposit growth was 3.9%, say almost 4% sequentially, which is the December over the September quarter. That's for deposits. And the sequential growth on the advances side, on the loans and advances, was 4.4% over September 2017. Growth has come at almost similar growth rates, just a couple of percent difference between the retail and wholesale growth rates. So both the segments have contributed to the fairly strong loan growth. And the mix now is about 55% retail and 45% wholesale. On the asset quality front, as at the end of December, the gross NPAs were at 1.29%, net NPAs were at 0.4%. Our branch network was at 4,734 branches in 2,672 cities. And finally, on capital adequacy, the total CAPAD was at 15.5%, and Tier 1 CAR was at 13.6%. Just a couple of more clarifications which I'd like to give upfront, especially because some of these things were, referred to in our previous quarter as well. As you might remember, in the September quarter results, we had mentioned that we had made contingent provisions in respect of an account which was under supervisory review. Immediately thereafter, on the day after the quarterly results, we had received regulatory communication, and we had put out another press release mentioning that that account had been classified as non-performing as per directions from the regulator. We have with our results also explained the total divergence that had come out of the supervisory process, and where we are in respect of those accounts, in respect where the asset classification had been changed. There were 3 accounts, one of which was what I just discussed, where it was made NPA in the month of October, and though it was, the instructions were that the account was to be recognized as NPA, and the effective date of that recognition or of that classification was March of 2016. So the accounts which had to be declared NPL had to be classified NPA as of March 2016. Because this was was accounted for in this quarter, we have given the divergence during this quarter for the March 2017 NPA numbers. For that account, again something which we have given with in our notes, that account, based on the 2 factors, which is that the account has, for the specified period from the 2016 period when it was the effective date of the NPL, then onwards has never crossed 90 days, and the fact that there were nil overdues for all the banks in the JLF. The JLF decision was that this account is therefore eligible for upgrade, and that has been done. Which is why, if you look at the end of the December quarter, this does not remain an NPL in the books. So to go back to the contingent provisions that we had made in the previous quarter, when the account was reflected as an NPA during the quarter, obviously those contingent provisions would have become specific provisions. However, since by the end of the quarter these are not required now, the contingent provisions are no longer required, or the provisions are no longer required, they do not continue as contingent or specific provisions. What we have done clearly is that the contingent provisions in the last quarter had been created, which were roughly 700 crores, had been created, half of them from floating provisions, which have been reinstated as floating provisions, and the other half has gone towards a higher general provision for stressed assets, for stressed sector, and for a contingent provision for a certain agriculture portfolio. The point being, therefore, that the entire 700 crores roughly of contingent provisions, none of that has been reversed back on a net basis into P&L for this quarter. So coming back to I think the clarification which I was, which is again, all of this is, there in terms of the movement of the divergence and where we are has been mentioned in the notes with the quarterly results, but I thought I should spend a minute on, having this sort of shared with all of you. Let me take a pause here, and I think we'll take your questions now.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset mode while asking your question. Anyone who wishes to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mahrukh Adajania from HDFC Securities. Please go ahead.
Yeah, hi. Could you share the slippage for the quarter and the breakdown of floating and specific provisions?
So the net increase in the gross NPLs for the quarter, this is of course, you're going to have in this quarter a slippage and a upgrade, right? So if you include the account that I referred to, which on account of divergence was recognized as NPA, and then this in the same quarter sort of getting upgraded as well, the slippage would therefore have been at 1.67. Yeah. And as far as provisioning is concerned, the floating provisions now go back to 1,300 crores, 1,326 to be precise. And the specific provisions for the quarter are essentially the total provisions for this quarter almost entirely were therefore on a net basis specific provisions, leading to a coverage ratio of about 66.3%.
Sorry, Paresh, I actually missed the slippage figure because I got thrown off the call for a short while.
1.67, including the fact that we had this slippage.
Including the fact that you had the
slippage and then the upgrade, right? So,
right. But all the other 2.9 billion were also classified in this quarter only?
No. Of the balance amount, which were, of the 3 divergences, the other 2 had already been classified as NPAs in June, September, and so on, at various points of time when they, became NPA for other reasons.
Perfect. Thanks so much. Thanks a lot.
You're welcome.
Thank you. The next question is from the line of Manish Ostwal from Nirmal Bang Securities. Please go ahead.
Yes, sir. My question on the fee income during this quarter, it has been growing around 30% YOY, and even forex income also grew very strongly. So any one-off in these item, and what is the sustainable growth rate for these 2 lines?
Yeah, so I think again the rate of growth, especially on fees, we've had a good quarter on fees. No major one-off for the quarter. However, when you look at the rate of growth, again, the December quarter for last year was muted. If you remember, there were some fees that banks were not allowed to charge in the December 2016 quarter.
Right.
Right. And as a result, if you look at the fee growth in 2016, that is 2016 or 2015, fee growth was muted at around 10%. So it was a bit of a lower base, which does help the rate of growth for this quarter. Having said that, even if you look at it sequentially, the fee growth has been fairly healthy, and that rate of growth has really come from a couple of businesses. One of them was a third-party distribution piece, where the mutual fund especially the mix of mutual funds towards equity has given a boost to that income. And of course, there's been a higher volume of third-party distribution fees on the insurance side. And the third contributor has been processing charges on retail loans, especially on auto and commercial vehicles and so on, because that was a segment that was in this quarter we saw a healthy growth in disbursements, and that therefore has been the other contributor for fees. So if you look at it, the rate of growth at 30 seems higher than what would have been the case if the base had been a normal base. But the growth rates areas have been these two or three.
And in exchange and derivative, there's no one-off, right?
No, in exchange and derivatives also there is no one-off. But in the last couple of quarters, in fact, we've seen slightly lower growth rates, and this was just a slightly stronger quarter there.
Okay. And second, what is your assessment over the credit cycle and the credit growth in the system now? A couple of banks reported very strong set of sequential credit growth also. So what is the assessment whether the retail is picking up strongly and corporate also coming back? What is your assessment?
So I think you've seen that even at a banking industry level, the rate of growth, which was languishing at around 6 or 7%, has moved up to, I think, 11.1% as per the last print that we've seen. So there has been some pickup in loan growth for the banking industry. I think part of it could actually represent a slightly stronger demand for credit, although it is still much more on the consumer side, but a little bit of it coming through on the corporate or wholesale side as well. And the other piece is that I think the proportion of loan demand which was being cannibalized by the debt markets, whether in terms of commercial paper and bonds and so on, I think that has, at least in relative terms on an incremental basis, started coming off, maybe representing the slightly lower liquidity in the system, and perhaps where the market rates have moved vis-a-vis loan rates in the last month or two. So I think both these have given a bit of a boost to loan growth for the banking system. And then within that, of course, banks who have been either in those segments which are seeing stronger growth, especially retail, or banks which have been able to gain market share in some parts of wholesale have clearly seen stronger growth. In our view, we are positioned for both these. I think we have a strong retail franchise across products, and as, for instance, you've seen strong growth on, say, car loans or commercial vehicle loans, based on the underlying sales, that clearly has given a slight pickup in loan growth on the retail side. Products that had been doing well, like personal loans or credit cards, has seen continued growth. And on the wholesale side, between working capital, trade finance, medium-term loans, and opportunities for refinancing, including some amount of growth on the term side, that has contributed also in the 23-24% levels.
And last question on the operating expenses trend, especially if you look at the last 5 quarters, the average growth rate YOY in operating expenses is around 15%. And the revenue is growing close to 20% plus on a average YOY growth. So, and then now we are reaching 40% cost to income ratio. So that basically whether we can sustain this kind of cost income ratio, or being a retail bank, we can see some uptick in that ratio.
Yeah, I think I wouldn't focus on any one quarter as representative of what our annualized cost to income ratio would be for the full year. But as a trend, have we been focusing on continued improvements in the operating ratios and the operating leverage that we should derive? The answer is yes. There have been a few drivers, but in particular, the increased digitization has helped us both in terms of improved efficiencies and improved productivity on the sales side, lower costs on the credit and operation side, especially as higher and higher proportions of our origination are capable of being processed either straight through or at least some components of it being processed on a straight through basis. With incremental branch expansion slightly lower than what it used to be, and earlier branches which are now 2, 3, 4 years old, having gradually getting into higher productivity levels and therefore reaching break even, both of those are contributing. We continue to invest, however, across various businesses. So from our point of view, we sort of don't have a number that we are guiding to. We don't have a guidance on either any revenue or expense lines. But our attempt, of course, will be to remain focused on improving the cost-to-income ratio.
Yeah, one small point. When we are completing our capital raising.
Manish, can I request you to come back in queue a little, because I think I
understand. Thank you, sir. Thank you very much.
You're welcome.
Thank you. We would request participants to limit your question to 2 at a time. We'll move to our next question, which is from the line of Kunal Shah from Edelweiss Securities. Please go ahead.
Yeah. So broadly, in terms of the overall provisioning breakup.
Sorry to interrupt you, Kunal. Can you please come a little closer to the phone?
Yeah. So the breakup of the provisioning between the general, specific, and any investment depreciation during the quarter, if we look at it, 1350 crores kind of a number overall.
Yeah. So the depreciation of provisions, on the investments doesn't come through the provision line in any case. That would, if you look at the other income line, in that the profit or loss on investments is the net of what gains we would have realized, net of any negative mark to market. So that comes in that line itself. The provision line itself of 1351, does have a, effectively is almost entirely out of that 1340 odd would be the specific provision, because to the extent that there is a general and a floating provision reimbursement, so to say, that was by the reversal of the provision that we had created earlier.
And there was no sale to ARCs during the quarter?
There was no sale to ARCs during this quarter.
Okay. And lastly, in terms of the fundraising which we are planning, of 24,000 crores, so how would be the utilization in which particular asset segment would we see it, be it either through organic or inorganic route? So what would be the focus area overall? And in terms of the unsecured portfolio, so now that's growing at a steady pace, 16% of the book. So do we still see it growing at a similar levels, or we would want to cap it at a particular level?
Well, in relation to the capital raising, clearly it's not being raised with a specific allocation of that incremental capital either for specific segments, for instance, between wholesale and retail assets, or specific products within these segments. The basic point is that the rate at which we have been growing our risk assets, that's been higher than what our internally sustainable growth rate is. And we have therefore been consuming, depending on the quarter, anywhere between 20 to 50 basis points in a quarter. On an annualized basis, a little more than, somewhere between 1 to 1.5%, sometimes a little less, sometimes a little more, depending on the composition of that asset growth, has been where our capital has been being utilized. On the other hand, we have also been designated as a domestic SIB, and that again increases the threshold slightly in terms of the capital requirements. So when we are looking at this capital raising, we are looking at essentially boosting our capital adequacy ratio to support our growth plans for the next few years. We believe that there are opportunities across wholesale retail and across in retail, for instance, the secured loans as well as unsecured loans. But that's got more to do with the market opportunity and our positioning and the competitive environment, and not really to do directly with the quantum of capital or the actual capital raising at this point of time.
And unsecured?
Yeah, I think the unsecured piece, whether it's personal loans or cards, still continues to grow. Of course, as I mentioned a little earlier, in this quarter, if you look at the absolute growth, the secured retail loans have actually grown in absolute terms much more than the unsecured.
Okay. Yeah.
Of course, they are larger books as well. So the percentage growth might look a little lower, but if you look at the sheer size of the growth, you'll find that that's where the higher portion of the retail growth might have come from.
Okay. Yeah. Thank you.
You're welcome.
Thank you. The next question is from the line of Ravikant Bhatt from Emkay Global. Please go ahead.
Hi, thanks for the opportunity, sir. My question pertains to the non-performing assets. Now, if one were to look at the period prior to March 17, your gross NPA ratio had for a very long time ranged between 90 to 110 basis points. And after that, I think first quarter you have had some farm-related delinquencies, and there have been other specific episodes. Now your GNPA ratio stands at 1.29%. So, any thoughts whether we are going back to lower levels, or there could be some continued accretions due to which the ratio has now touched a kind of a different normal, which could be upwards of 1.2% or 1.3%?
Yeah. So I think one, I would certainly say that the sweet spot of somewhere between 1.1%. I think we have clearly moved a little higher than that in the last few quarters.
Correct.
And at this point of time, while we've seen a movement 2-3 basis points here or there, I think we certainly seem to be closer to the 1.2, 1.3 than the 1.1 that we might have been for a couple of years. Again, it really depends on the time horizon that you're looking at, because if you look at our 20-year history, then we've been at higher levels as well, and in fact the average might well have been somewhere closer to the 1.3 than where we were for a few years, which is why I called it a sweet spot for quite some time.
Right.
Having said that, I think specifically, even in this quarter when we've seen some increases, they've come once again from the agri portfolio. And this is something which I think, a slightly heightened level of agri-related NPLs, is something that I think we'll just have to perhaps live with. There may be different factors at different points of time. Certainly in the last year or two, a combination of some natural calamities, some issues on realizations, post what happened in terms of the availability of liquidity post demonetization in the rural sector, and then the announcements and the protracted implementation of some of the loan waivers have certainly been contributors to this particular segment's NPLs. Nonetheless, we still think that it's important for us as part of the requirement for us to meet our mandate for agriculture lending, including small and marginal farmers and the direct lending to agriculture, that we will have a certain sized portfolio in that segment, and the reality of the risks out there will show up from time to time. So that's really where we've seen the growth. Other segments where we've seen ups and downs, we've had in the past something to do with commercial vehicles and construction equipment, which then got pulled back. We've seen some ups and downs on the SME side, but in more recent times, as I said, the agri portfolio has certainly contributed to some of the NPL formation. And on the corporate or the wholesale side, you would have one-offs every few quarters. It's less predictable, or it's less of a trend that you can notice every quarter. But every few quarters, if you look on an annualized basis, it's still a portfolio for us which has held up rather well.
Sure. Well, thank you, sir. That's a very helpful comment.
You're welcome.
Thank you. The next question is from the line of Adarsh P. from Nomura. Please go ahead.
Hi, thanks for the opportunity. Please, just again had the same question on asset quality, right? So, one is you clearly identified agri contributing. So, where have the NPA levels trended from March in the agri book?
We have seen increases. Remember, the agri book, the period for classification is not what it is for other loans, right, where it is 90 days.
Yeah.
So this really depends on the crop cycle and so on. So if you look at even the percentage growth in agri from where it was, let's say in December of 2016, as a percentage of the gross advances of that particular portfolio, you have seen in percentage terms, we've come to a little over 5.5% for the agri portfolio, roughly in that range, somewhere between 5 and 6%, and that is at least a couple of percent more than what it was a year back. So that is where it is now. Some of that, as I said, could be linked to some of the factors that are more specific to this year, right? Especially when it comes to things like loan waivers and so on. You didn't have it earlier. And some of it, once the disbursements actually take place, some of it might get pulled back. But that has been the trend even in the last 12 months for this particular portfolio. For some of the other businesses, we've seen some ups and downs, while this one has seen probably an increase which has been a little more unidirectional.
Just getting into this a little bit more, like 700 crores of quarterly provisioning we had right before the demon quarter, and then we've had almost a 2x kind of run rate on credit cost or provisioning. As part of it is part of it would have been agri, then some SME related to GST, demon, everything. So is like at least the excluding agri part, right? Is that settling lower again? Because we kind of get that feedback from say NBFCs, banks that's kind of settling lower. So is that the case? Should we expect that to happen for a bank or?
So I would say that if you are referring specifically to what was seen as an impact of demonetization or for instance on our SLI portfolio or again the demonetization and to some extent the transitional GST impact on maybe SME. Some of those, I think, certainly the demonetization impact, I think, on asset quality is true. I don't think there's any residual new formation of NPLs which you can even remotely attribute to what might have happened, a year back. As far as the rest of the slippages or any delinquency formation is concerned, it's fairly stable. I mean, we don't see a trend, continuing across a couple of quarters for any of the other businesses. In some of the retail loans, we've seen some increases in some quarters and, stabilization or coming down again in some quarters. So we have seen, it's not that all the other segments have seen extremely stable asset quality, but you're talking about a few basis points up and down. And, across these products, the actual NPLs have still been within what is priced in or what we believe is fair for those products. So I do believe that generally speaking, the asset quality, at even the levels that we've seen, in the ex-agri, as you said, I think there's been reasonable stability out there.
So from a mix perspective, you don't think that, excluding these volatilities, the credit cost for the bank on a more longer term, right, 3-5 year average running basis, should be higher now going forward versus what it was. I'm just trying to say, adjusted for the fact that, as you said, we are beyond the sweet spot in retail, so maybe 10-20 basis point higher. But from a mix perspective, do you believe that there should be a higher increase in the structural credit cost or?
No, I wouldn't say really structurally based on portfolio mix. That should contribute to any meaningful change. I mean, other than what I mentioned in terms of the cycle for specific businesses, and I'll explain why briefly. If you look at the wholesale retail mix, it hasn't changed too much, although retail has gone up slightly, which should contribute a little more than wholesale. But again, it's not huge. Within retail, you've had an increase in unsecured, which should have been higher risk, but you've also had an increase in home loans, which is lower risk. So on a blended basis or a weighted average basis, I don't really think the mix by itself is going to result or is going to cause a meaningful change in the credit cost. But yes, I mean, a mean mean reversion in some ways in terms of the gross non-performing loans and the provisioning is something that we have been seeing in the last few quarters.
Perfect. Thanks a lot, Prish. That was it. Thanks.
You're welcome.
Thank you. The next question is from the line of Degan Dharia from Antique Stock Broking. Please go ahead.
Yeah, hi. We can see that all the high-yielding products, especially credit card, personal loans, and two-wheeler loans, like there's a big jump, whether you look at it YOY, QOQ, or whatever way. So is this pointing to some kind of a consumption boom, which may sustain for some more time, or it's more of, a pent-up of a lot of things which happened in the past, and this quarter is when that pent-up demand from, the consumers came?
Yeah, I think certainly if you look at purchases of, because all these three products, not personal loans so much, but if I look at two-wheelers, and frankly, I would see, auto loans or CV, you did actually see higher sales driving those loans, right? Personal loans and credit cards in some respect had been growing even earlier. Of course, this is the festive season, so you tend to have higher spends on credit cards and slightly higher revolve during the quarter. So this quarter, in any case, tends to have a seasonally higher growth rate in consumption-related retail loans. So I think we should watch whether this trend continues for a quarter or two more before we jump to the conclusion that yes, this reflects a revival in the consumption boom, if you might. But also, I think if you look at some of the growth rates that we are seeing in semi-urban, rural, we have seen a slight pickup or a slight improvement in those growth rates vis-a-vis the previous few months. Nothing very stark, but certainly a little bit of pickup, which again might point to better sentiment, better monsoons having been better, resulting in slightly better consumption in those markets.
Okay. And second is on the commercial vehicle loans, we have seen some really strong numbers for the third quarter, but I think our portfolio does not reflect a similar set of growth. So maybe have we pulled out from some areas where competition have become irrational, or if you can just throw some light on that.
Well, within that, some segments we have been a little more cautious, but I can't say that we have pulled out of any segment. Maybe in some we might have not grown as as fast as we might have been doing a little earlier. But honestly, sequentially 5%, 5.4% is the as per our own internal MIS, and if you look at the as per the Basel classification, then the CVCE business has grown 5.7%. And remember, this is for us the combined portfolio for the commercial vehicle and the construction equipment piece as well. So, but yeah, it's grown at about 23% year on year. I know there may be some players, and especially who are operating in certain segments, who've grown faster. But I wouldn't say that we have pulled out of any particular part of the business.
All right. Thank you very much.
You're welcome.
Thank you. The next question is from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Thank you so much for the opportunity. So I would like to understand.
Sorry, Rohan, can you please speak on the receiver? Your voice is echoing.
Is this better?
Slightly better, thank you.
So, sir, how do you see the lending opportunity in the salaried segment, having income somewhere, say, up to, say, 25,000 per month? And that was my first question. Second is within the retail loans, whatever lending we have been doing up till now, are there any pockets where we would have turned cautious incrementally, maybe some color on product-wise, geography-wise, or maybe on the customer segment? And the third was, in terms of the number of, what would be the number of total retail customers that we have, and within that, what percentage of the customer base would we already be offering unsecured products like personal loans?
So, as far as this salaried segment, we have a range of products, some of which customers would be eligible at the salary levels that you mentioned. But when it comes to the full range of products, whether it is everything from a unsecured loan or a two-wheeler loan to auto, to loans against shares, to credit cards, whether it's salaried or self-employed or small business, the product programs that we have look at a combination of credit factors, including, of course, income levels. But we have developed, we use several parameters to be able to make those calls, and to the extent that many of these customers have an existing banking relationship with us, a lot of the data that we look goes beyond the application or the profile of the customer, including behavioral characteristics that the customer has displayed in their relationship with us in the transactional account. So we see opportunities for salaried retail lending, but we also cater to other segments. And within salaried, again, there are customers who may be open market, and there are those who are salaried and who have their salary accounts with us. And our products are tailored to being able to meet those customers' requirements within our credit appetite. And we have obviously done a lot of analytics to be able to provide them offers and to fulfill them as seamlessly and frictionlessly as possible. On the
retail loans that we have been offering up till now, retail products that we have been, and within that, are there any products that we would have turned cautious?
Yeah, I don't think there is a product that we have turned cautious overall, in the sense that we are cutting back overall. But in every single product, at all points of time, including those products which on an overall basis, we are growing, there will be some segments, or there will be some geographies or some profile that we will be constantly tweaking in terms of either rationalizing some part of our origination there, or tweaking the pricing where possible, or stepping up on some collection activity somewhere, because portfolio management on the retail side is an ongoing process. It's only when a product really blows out that you are going to take something, take a very severe action of pulling back, which certainly is not the case for any product at this point of time. And on your last question, I don't think I have a ready breakup of from our total customers what portion we might have already lent unsecured. But if I look at it from the other point of view, in terms of our origination of personal loans or credit cards, then even today on an incremental basis, roughly 50% of our personal loans tend to be extended to customers who already have an existing relationship with the bank, and these could be either salaried or self-employed or business categories. But that's roughly 50% on the personal loan side, and it's almost 70% on the credit card side.
And so, what is the total number of customer base that we are having on the retail side?
Our total customer base now would be about 43 million.
Okay. Thanks a lot, sir.
Thanks. Since we have just about 15 minutes left, I would certainly urge each one of you, if possible, to stick to one question, but certainly not more than two.
Thank you, sir. We'll move to the next question, which is from the line of Abhijit Sakhare from Kotak Securities. Please go ahead.
Good evening, sir. I have a question on fee income. We understand that you have opened up your partnership on the life insurance side. You now deal with multiple life insurance partners. So in that context, wanted to understand how does it operationally work? So do you divide branches among insurers, or do you split channels? So some kind of flavor on that.
So we've not yet started all the products through the branch channel, but for the time being, what we have done is we've given each of the insurer some specific channel or segment, so that they can integrate into the entire banking system that we have. When we are selling insurance, we already have a pretty well-defined process, which includes calling from the bank itself, And so some of these newer companies who are coming on board in this financial year at least, we're going to test them out with some smaller segments or smaller channels before we open it up from the branch channel.
Okay, so branches as of now are 100% with HDFC Life.
Absolutely.
Okay, so there is no thought on changing that immediately as of now?
There will. So once these new companies integrate into the entire process that we have, we will open all the channels to them. But it takes a little while for the newer companies to integrate their CRM, their processes into our systems and our back-end processes, because we run a pretty tight shop there.
Right.
Once, as and when those guys come up the curve, we will let each party have full access to all the channels.
Okay. So next question was a very small clarification. The housing loan book has shrunk sequentially. Any specific reason there?
No, it's just that in this quarter we haven't done a purchase. I guess when we'll do it next, it'll even out.
But there is no specific reason for not doing it this quarter?
Not really.
Okay. Okay. Thank you.
Thank you. Request participant to limit your question to one at a time. We'll move to our next question from the line of Nilanjan Karfa from Jefferies. Please go ahead.
Hi, Paresh. Question on the asset quality. You kind of also mentioned a long-term, track record. And then when I look at the last 20 years data, right, not necessarily it's comparable, but we used to have like credit costs of between 1.5% to 2% at a time when I think the margins would be upwards of 4.5%. And this relationship had broken somewhere around in 2011 and continues till date. Although of late, there has been a significant increase in the overall asset quality and therefore in the provisions. How should we look at it? I think I'm just asking the same question asked earlier, but in a different way.
Well, I mentioned this earlier. We don't have a guidance to either a gross NPA number or a credit cost number. I think our strategy on the portfolio itself, in terms of mix, in terms of the way we go about our business, I think is reasonably well understood. While we are looking to grow faster than the system, and therefore we are looking to add market share in almost all our businesses, we are looking to do that while maintaining a fairly stable net interest margin in a certain range and asset quality that we believe, or a credit appetite that we believe is consistent with the returns that we get. Now, if you look at the historical range, we've been through various cycles. Some of the higher ranges on that gross NPA number was also linked to acquisitions that we did along the way.
Yeah.
So, but if you look at the core growth and you look at also the way the portfolio has evolved over a period of time, on a product by product basis, we factor in a certain expected loss, and as long as that is priced into the yield, and we are managing to that expected loss, we are comfortable doing that business. I don't think the philosophy, this philosophy of growth or this philosophy of lending is changing, nor is our portfolio taking a certain turn which would change these broad parameters. But within that, whether it is closer to the 20-year average or lower than that, because an average is an average. That means that there would have been almost an equal number of times that would have been higher.
Correct.
So at this point of time, if we sort of remain in a range which is not out of line with what we have been doing in the last few years, and yes, if there was a conscious change in the product mix, which was consciously taking on higher risk, which I'm not saying is the case, then that naturally would imply that we would have a higher yield and theoretically a higher NIM to absorb those losses. But I don't think we are going through any specific change in the mix or change in the growth rates which would result in that.
Right. I'll squeeze in this question specific to GST. How are you looking at your SME or MSME customers in terms of their turnovers, or more importantly, we had this huge hope about this people coming from this unorganized to organized segment. So what has been your experience so far?
I think it's still very early to take that call. I still think that is something which will happen, but it's not going to happen, in months. It will probably happen in a few quarters, because remember, it's not that these customers will suddenly, because they have to bring in more on their books. The financials which will reflect this will come next year or thereafter, and based on those financials, and then sort of with the added information that we get on a transactional basis, would we be able to take in names that were otherwise not reflecting their full level of activity in their books. So I think from a medium-term point of view, this still remains an opportunity for the banking system, that players who are so far not able to access financial services from the formal or the banking sector might be able to, and might be potentially customers for banks. But it's too early. Right now, we haven't yet quite seen that.
And on their own transaction, overall volumes, are you still seeing some pressure, and would it therefore imply our underwriting to these guys are tighter than in the past?
Yeah, I don't think they have been through the transitional pain completely. Things are, I think they're getting used to the new regime, and the logistical and reporting and other issues which they have to deal with. But I don't think the transitional impact is through yet for most of those customers.
Excellent. Thank you so much, Paresh. Thank you.
Thank you. The next question is from the line of Hiral Desai from Anai Portfolio Managers. Please go ahead.
Hi, Paresh.
Hi.
So just had one question. As an external investor, when we look at the cross-sell ratios for you, is there a number or, something that you can share which gives us an idea on, your ability to internally cross-sell? And, how has that changed over the last 3 to 4 years?
So our ability to cross-sell has certainly improved to the extent that, we've been able to not just collect, but analyze and, digest and analyze and, put together products, make offers which are much more relevant to the customers. So I think these scorecards that we have built, for various products, and therefore the ability for us to, across various marketing campaigns, as well as to figure out from a credit perspective or from a fraud perspective, the use of analytics to improve the ability to cross-sell has certainly, been much better. And in addition to, the managed customers being, offered those products through the person who's managing the relationship, the digital channels, getting customers to, see those offers popping up when they access any of our digital channels is also helping. So we track this, of course. That's not data that we put in the public domain, but we do track this in terms of the number of products that we've been able to offer, and customers have been happy to take from us across products which are both slightly higher on engagement.
There's nothing that you can share, either in terms of numbers or percentages or anything of that sort.
No, we haven't on customer level. Penetration data, I don't think we have put ever in the public domain, and I wouldn't be doing that at this point of time.
Okay. And the other question was specifically on the retail piece, both from a stock and flow perspective, what percentage of our book, maybe comes from top 20 cities? So I'm just trying to understand how much of
I don't have that data readily available with me, but across some of the retail products, it could be fairly high. I mean, let's say a product like, say, credit cards, it would still be for personal loans, or let's say even loan against property. Some of these products, it would be fairly high in the top 20 cities. But if you look at products like two-wheelers or even auto, it's fairly well dispersed across, metro or urban and semi-urban.
Cool, this is helpful. Yeah, thanks.
You're welcome.
Thank you. The next question is from the line of Sachin Seth from ICICI Securities. Please go ahead.
Yeah, hi Paresh. Thanks for the opportunity. Just a quick question on the liquidity and the rate environment, because we saw this huge flow post-demon, and that seems to have clearly slowed. Plus, RBI has been sucking out the excess liquidity. So when do you see the battle for deposits start to heat up and increasing deposit rates?
I think that's a great question, because we're probably at that inflection point sometime right now, because we've seen somewhat muted deposit growth for some time post the initial flow of the demonetization, which you rightly referred to. But it wasn't an issue because loan growth was also muted, right? Now that we've seen a pickup in loan growth, you've already seen pressure on banks to perhaps look at slightly higher deposit rates, which in turn therefore tends to flow through into slightly higher MCLRs. And in this sort of a demand supply environment, given that there has been a change in the stance from a monetary policy point of view, and for instance from January this year the LCRs for banks have also been increased. All of this clearly tends to nudge banks towards a slightly higher interest rate regime from a just driven by deposit rates being that much tougher to come by. So I think it's not sudden or it's not huge, but I think we are gradually getting into that sort of a mode over the next few months, I think.
Great. Thanks a lot.
Thank you. The next question is from the line of Dhaval Gada from Sundaram Mutual Fund. Please go ahead.
I think this will probably have to be the last question because we're almost coming to the end of the call, but go ahead.
Yeah, thanks, Paresh. Just three data keeping question, the upgrade, recovery and write-offs for the quarter and the employee count.
Sure. Employee count is about 86,600.
So, the additions and the reductions are both going to be including the names which was where we had increase and reduction. So the additions were 4,588 crores. The reductions were 4,056 crores, which included the upgradations as well.
And write-offs?
Write-offs during the quarter were 1,000 crores. 1,040 crores.
Thanks.
Okay, I think we've run out of time. We've probably been able to address most of the questions. Maybe if we couldn't accommodate a couple of them, I'm sorry about that. But hopefully the questions that you wanted to ask might have been covered by some of your peers earlier on. Once again, thank you for being on this call. As I had mentioned right in the beginning, it's a quarter where we did see strong balance sheet growth, although the growth rates were a little distorted based on where we were in December last year. Margins were roughly stable, some improvements on the fee growth side, resulting in revenue growth outpacing operating expense growth, and the bottom line being at around 20% in terms of growth rate. Thank you once again, and have a great year.
Thank you.